This is absolutely crazy. Right now, there might not be any other asset in the world that's been snapped up like gold by central banks, global investors, businesses, and regular people all at the same time. And the key here is, they are all going after physical gold. This could be the biggest scramble for real gold we've ever seen. And with this frenzy, global gold prices just keep climbing, hitting new record highs almost every day.
On February 11th, the COMEX gold futures price on the New York Mercantile Exchange broke through $2,960 per ounce, setting a new record high. In fact, the gold bull market has lasted for a decade. At the end of 2015, COMEX gold futures once fell below $1,100 per ounce, but then rose year after year. In 2023, prices hit new highs repeatedly, with a total increase of more than 13% for the year. In 2024, gold prices have already gained more than 27%. As of February 14th, COMEX gold futures have risen nearly 10% this year, after briefly touching $2,968 per ounce. As spot gold and COMEX gold prices continue to hit new highs, domestic gold jewelry prices in China have also surged. Most brands now charge over 800 yuan per gram. For fixed-price jewelry, which includes design and craftsmanship fees, the price per gram exceeds 1,000 yuan. Meanwhile, the base investment price during the same period was around 670 yuan per gram. As of February 15th, major brands in China were charging close to 900 yuan per gram. According to the China Securities Journal, at 10 a.m. on February 14th, a gold store in Beijing's SKP Mall saw long lines outside right after opening. One frustrated shopper said, "I can't even squeeze into the store. The wait is at least 6 hours." Many shoppers shared similar experiences. One person said, "It's so hard to buy. The gold pieces I liked were all snatched up by the scalpers." Recent reports from various gold jewelry stores like Chow Tai Fook, Chow Sang Sang, Lao Feng Shang, Lao Miao, and Luk Fook revealed that around February 10th, gold jewelry sales were booming. A staff member at one store said daily sales during that period exceeded 100,000 yuan, much higher than usual. Bracelets, necklaces, and pendants were the most popular items. On the evening of February 8th, a store employee said, "Today, we made over 70,000 yuan in sales. Many loyal customers who didn't buy before the holiday came back after seeing prices go up again." Ms. Meng from Beijing joined the gold rush after the Lunar New Year. On February 9th, she arrived early at the mall and said there was already a dozen people in line before the doors opened. The moment the mall opened, everyone rushed straight to the gold store. The gold buying frenzy isn't limited to Beijing. Similar scenes have been reported in Shanghai, Hangzhou, and Henan province.
It's already past 8 p.m., but there are still long lines outside the gold stores.
I came here first thing when the store opened. They're handing out queue numbers. For locals, it's not too bad, but for people coming from out of town, they might have to wait all day just to get their hands on some gold. In Hangzhou, a woman named Ms. Wang spoke on camera saying, "I left Jiaxing at 5 a.m. just to join the gold buying crowd." Ms. Feng, a shopper waiting in line for jewelry, said prices have been rising too fast lately. She explained that many people follow the mindset of buying when prices go up, not buying when they fall, which has fueled a rush to buy gold. Because of the long lines, some scalpers have even started selling queue numbers for a profit. Right now, buying gold in China means waiting at least 6 hours in line. Scalpers are taking advantage of the situation, reselling spots in line at a markup. It's not just jewelry stores seeing this surge. Even the source of gold itself is under pressure. Shenzhen's Shuibei district, the country's largest and most developed gold and jewelry hub, hasn't escaped the chaos. Reporters from Daily Economic News found that parking was nearly impossible. By the afternoon, traffic was backed up and crowds kept growing. One reporter described the scene as resembling a busy vegetable market. A woman from a gold factory described the rush, saying, "People are bringing out bags of gold to sell. With prices this high, they're cashing in. Anyone with gold at home is selling it now." As the gold rush intensified, there was a sudden drop in international prices. On February 14, the London spot gold price fell 1.5% on a single day, closing at $2,882 per ounce, the biggest daily drop in nearly 7 weeks. Domestic gold jewelry prices also dipped, falling to 875 yuan per gram, with some brands lowering prices by as much as 18 yuan per gram. But this price drop didn't cool the market. Instead, more people rushed to buy gold, with some waiting for 8 hours just to buy the dip. One early morning after another has turned unusual because of this gold rush. At 4 a.m., before the sun rises and with freezing winds blowing, long lines have already formed outside jewelry stores across the country. People are bundling in thick winter coats, rubbing their hands and stomping their feet to stay warm. But their eyes shine with excitement. They're not lining up for limited edition sneakers or the latest smartphone. They're here for gold. The optimistic outlook on gold's future is one of the key reasons people are holding on to their gold. From a monetary perspective, global central banks have been aggressively stockpiling gold, driving prices higher. According to the World Gold Council, central banks have purchased over 1,000 tons of gold annually for the past 3 years, with 2024 alone reaching 1,045 tons. Countries like China, Poland, and India have significantly increased their reserves, boosting demand and sending a strong signal to the market. As 2025 begins, gold prices continue their strong upward trend from 2024, repeatedly hitting record highs. Goldman Sachs analysts predict gold could reach $3,000 per ounce by the second quarter of 2026. Looking ahead, China International Capital Corporation projects that gold remains in a bull market. It could surpass $3,000 per ounce in 2025. The firm also noted that the yuan-dominated gold prices may rise even faster than those in US dollars. CITIC Securities echo this optimism, forecasting continued central bank gold purchases that could further drive prices upward. A shopper waiting in line said in an interview, "If I don't buy gold now, what if prices go up again?" This sentiment reflects what many people are feeling. Gold is more than a commodity or a currency. Its key role is as a safe haven asset. Ongoing geopolitical tensions, including conflicts in the Middle East and the war in Ukraine, continue to fuel uncertainty in the global economy. Meanwhile, U.S. tariff policies have added to the market anxiety. In this environment, gold has drawn strong investment interest, driving prices higher. Recently, U.S. President Donald Trump announced a 25% tariff on steel and aluminum imports. This decision has raised concerns about escalating trade tensions and rising inflation, which analysts say is a key factor driving gold to record highs. According to a Reuters report, China, the world's largest steel producer, is not a major supplier to the United States. However, Trump believes China's steel exports have indirectly caused other countries to increase their exports to the U.S. He also claimed that the rising U.S. steel imports prove that some Chinese steel might be entering the country through third-party nations. On February 10th, Trump raised tariffs on steel and aluminum to 25%, which sent U.S. steel stocks higher. However, he also said Australia might be exempt from these tariffs. The new measures are set to take effect on March 4th. George Lagarius, chief economist at Forvis Mazars, said, "The market sees Trump's tariff move as a negotiating tactic, so people are waiting to see the actual impact." Gold prices surged as demand for safe haven assets increased. At 7 a.m. London time, spot gold was up 0.3% at $2,916 per ounce, after briefly touching $2,943. According to Reuters, three main factors have driven gold prices over the past 20 years: consumer demand from China and India, central bank purchases, and global capital flows. When all three factors align, gold tends to rise significantly. The strongest factor has been consumer demand from China and India, which together account for more than 53% of global consumption. In 2024, China's gold demand reached 816 tons, a 10% drop from 2023. Meanwhile, India's gold consumption grew by 5%, hitting 803 tons. Combined, these two countries consumed 1,618 tons of gold last year. While China and India remain the dominant forces in gold consumption, the growth has slowed in recent years. As a result, the other two factors, central bank purchases and capital flows, are playing a more significant role in driving gold prices. Both are difficult to predict. Chinese central banks have consistently increased their gold reserves over the past 3 years. Data from the World Gold Council shows that gold central bank gold purchases reached 1,045 tons in 2024. Although this was slightly less than in the previous 2 years, it still marked the third consecutive year of purchases exceeding 1,000 tons. However, China's central bank gold purchases are often driven by policy decisions rather than market dynamics. making future trends hard to forecast. Capital flows have also played a major role, largely driven by safe haven demand and hedge fund activity. These flows are heavily influenced by international geopolitical developments. Financial analyst Wang Jian told Radio Free Asia that gold only serves as a hedge against inflation. He pointed out that China is not currently experiencing inflation. In fact, there are signs of a mild deflation, with asset prices falling. He said the rush to buy gold is not about protecting wealth, but more about psychological comfort. Wang explained, "The reason gold prices are hitting new highs isn't because of inflation, it's because of a lack of confidence. People worry about putting their money in banks, fearing account freezes or withdrawal restrictions. Some are uncertain about the economy and feel more secure keeping gold at home." The rush to buy gold in China is closely tied to the country's slowing economy and its situation on the global stage. Wang Guochen, an assistant researcher at Taiwan's Chonghua Institution for Economic Research, explained that China's economy is slowing and financial risks are mounting, putting pressure on the yuan. As a result, people are less inclined to save in yuan and are turning to gold instead. To meet this growing demand, the People's Bank of China must increase its gold reserves. Some gold stores in China have collapsed due to insufficient reserves. Customers who believed they had bought gold only had numbers in a virtual account. When they tried to withdraw physical gold, it wasn't available. This shortfall is pushing the central bank to continue increasing its reserves, driving demand and prices even higher. Wang added, "This is a case of passive gold buying. As for whether the People's Bank of China is actively trying to move away from the US dollar, we'll need more time to see. In recent months, China has been reducing its holdings of US Treasury bonds, shifting some of those funds into gold. Because foreign reserves are limited, to buy gold, they have to sell US bonds. At the same time, they're also trying to defend the yuan's exchange rate. All these factors are at play." In a recent article, columnist Milton Ezrati described the severe economic challenges facing China under the Chinese Communist Party. He explained that citizens are struggling to find safe places to store their wealth, which accounts for the brief housing boom seen earlier. However, the real estate crisis shows no signs of easing. Despite government efforts to stabilize the market, home construction continues to decline and sales remain sluggish. Since the crisis began in 2021, housing prices have fallen by at least 12%, significantly eroding household wealth, reducing consumer spending, and adding another obstacle to economic growth. For years, the government took little action, only intervening at the end of 2023 with limited success. As a result, many people see no reason to invest in real estate or other business ventures. The gold buying frenzy also reveals a broader economic slowdown. Reports have documented the ongoing collapse of many gold stores, with some customers losing millions of yuan in entrusted gold. According to a report from China state broadcaster CCTV, several gold stores in Beijing recently shut down, causing gold worth more than 100 million yuan to disappear. One of the closed stores was located in RNF Plaza in Beijing's Chaoyang district. Customers had signed up for a worry-free gold reservation service where they entrusted their gold bars to the store for safekeeping. The agreement promised a 2.5% gold bonus if the gold was stored for a year. At the end of the term, customers could collect their gold, extend the contract, or sell it back at market price. However, when the store abruptly closed, many tried contacting the company's headquarters, only to be told that China National Gold Group Corporation had no legal obligation to compensate them. Wang Jian said, "There should have been oversight, but there wasn't. China Gold is a state-owned enterprise and used to be the National Gold Authority. Customers trusted the company's reputation and handed over their gold, but the company let those franchise stores open without proper checks. People thought their gold was safe because of the state-owned brand, but it turned out these were just franchise stores. Now, whether it was a franchise or a company-owned branch, China Gold should step in and cover the losses." According to China Gold's 2022 financial report, the company had 3,642 stores nationwide, but only 105 were directly operated, while more than 90% were franchises. The uncertain global geopolitical situation is giving Chinese investors another reason to turn to gold. This is something people can't ignore when managing their wealth. The world is far from peaceful, with wars raging in Europe and the Middle East. At the same time, the United States, the EU, and Japan are all rethinking their trade relationships with the CCP. So far, they've all taken a cautious, restrictive approach. Even though the U.S. election has concluded, Washington's domestic and foreign policies remain uncertain. The U.S. has not yet eliminated inflationary pressures, and the future path of interest rates is still unclear. Another factor pushing Chinese investors towards gold is the ongoing global trend of de-dollarization. The CCP is leading this effort in some parts of the world, prompting central banks in many countries to increase their gold reserves. From a practical standpoint, it remains unclear whether the Chinese government can implement effective policies to address its economic and financial challenges. History suggests that this is unlikely. Domestic concerns over the worsening situation are unlikely to disappear anytime soon. Meanwhile, in the United States, while President Donald Trump has begun his second term, it may take months before there is clarity on domestic and global policies. Given these uncertainties, China's gold buying frenzy is likely to continue. It might slow down, but a full reversal is unlikely in the near term. The soaring price of gold has sparked a wave of enthusiasm among investors. But according to Dennis Gartman, a well-known investor and author of the once famous The Gartman Letter, gold trading might now be overheating. In a recent report from Kitco News, Gartman said he's been bullish on gold for years. For months and years, I've remained steadfastly bullish on gold, but of late, as gold has become more and more popular, I'm becoming marginally less enamored with it and have actually begun selling calls against what I own. I'm still optimistic about gold in the long run, he said, but the market is starting to look overheated. Back in mid-October last year, Gartman predicted a pullback in gold prices. At the time, he advised investors to wait for a potential dip to buy in. After the U.S. election in November, gold prices fell more than 7% before stabilizing and eventually surging again. Gartman also pointed to rising tensions over tariffs between the U.S. and China, along with the persistent risk of a global recession. In his view, both factors will continue to support gold prices in the long run. Meanwhile, Goldman Sachs, which has long been bullish on gold, recently issued a rare short-term warning. They said if tariff-related uncertainty eases and market positions return to normal, gold prices could see a technical decline. Goldman Sachs predicts that prices might drop to around $2,650 per ounce.